Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 9th, 2026. Hey, I hope you're doing well. I hope you had a good week trading. I really appreciate you coming to my weekend review podcast. I hope you're going to learn a lot. And boy, what a week last week was for the bulls. In some sectors, I should say. I mean, technology is just going parabolic, which is fantastic if you're in those stocks. For me, I had a so-so week, really not one of my best weeks. I got stopped out of quite a few positions, but really the important thing is that I got stopped out for small losses. And in trading, obviously having large wins is acceptable and great, but also having small wins, totally acceptable. Having break-even trades is also fine. Having small losses is totally fine in the calculus of profitable trading. It's just having large losses. That's really what's going to hurt a person's account. So, everything I do when I try to structure my trades, I structure my trades around do I have the possibility to have a large gain? Yes, 100%. But if I'm wrong, I structure it so that if I'm wrong, most of the time I can be wrong small. And that's what happened this week. So um, glad I followed my processes. Wasn't the best week, but um, having these small losses, I have the chance to get back in. So, and I'll go over that more as we get through the podcast. So the format for today's podcast is, first of all, we're going to run the US legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made, all the positions that I have, that I entered, that I exited. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, how I position size based upon the current volatility of the market, how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the market starts to move my way, what I do when I get into trailing stop level, and then ultimately how I exit the position. So basically, when I entered the trade, why I entered the trade, and how I'm going to manage the trade going forward. After that, I'm going to spend just a few minutes on trader psychology. It is the most important skill in trading, everybody. Trust me. Talk to any long-term trader, and they will tell you the biggest skill in trading is the ability to follow your plan. There's lots of plans. There's lots of strategies to follow. A lot of great ones. But if you don't follow them, they're worth nothing. So it's really important from a psychological standpoint to have a plan and follow it, and that falls into the category of trader psychology. So I always like to teach that. Helps me to teach it. Hope it's helpful for you as well. And if you find anything helpful in the podcast today or valuable, I really would appreciate it if you could hit the thumbs up button. Helps the channel out a lot, lets YouTube know there's some potential valuable content on the channel, in which I think there is. After that, last night I went down through my master watch list. I went down symbol by symbol, and I looked for potential setups for next week, and I found some pretty good ones. I have 7 of them that I'm going to share with you. Now, these are not where they need to be yet, but they're getting close. And what I'm looking for is I'm looking for a confluence or a combination of, if I'm going long, of support levels, RSI levels, major moving average levels, order block levels, double bottom bullish MACD divergence situations. So I have some really good ones for you. And at the end of the podcast, I'm going to share what I'm looking for next week. So anyway, that's pretty much what we're going to do here. So like I said, I hope you enjoy it. I hope you learned something. And let's quickly run this US legal disclaimer, get that out of the way, and we'll come back and get started. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, and listen, before we get started, I apologize for last week's video. I'll tell you, it was a nightmare. I started recording the podcast about two-thirds of the way through it. My screens blinked, stuff going on. I don't know if it's my software that glitched or my computer that glitched. I don't know, but then it came back online and seemed like everything was okay. But then when I finished it up, and did a playback to make sure it was working properly. The sound was there, but my screens weren't switching. So anyway, it was a nightmare, and I had something to do the rest of that day that I couldn't record it. So anyway, my apologies. I've been doing this podcast for like 8 years, and that has never happened. So I'm a little nervous tonight, to be honest with you, or this morning, to be honest with you. I hope it doesn't glitch in the middle. If it does, you'll hear me scream, and then that'll probably be the end of the podcast. So anyway, all right, let's start with the current positions that I have. So I did enter Love, which is Southwest Airlines, here on 4:30 at $37.83. So this is a combination of an order block and rejection of a major moving average. When I talk about rejections of major moving averages like the 200, the 250, the 300-day moving average, or the 30 RSI, I'm talking about a deep dip buy strategy. When I'm looking at this green box here, this green box is what's called an order block. And so I like confluences of signals where I have multiple signals together at the same time, and this is a confluence of both. So I entered here on the 29th with a close under and then a close over the 200-day moving average while it was in the order block. And so that's why I took the trade. You can see it's been a pretty good trade so far. But let's go back and talk a little bit about how I identify order blocks, the green box here. Now, a lot of people use order blocks. People use them in different ways. I use them the way that I trade and the way that I teach. I try to make it as simple as possible. And so if you see this and go, oh, I think order blocks is a different way, it might be for other people, but for me, this is the order block protocol that I use. And so for an order block, the way that I trade them, the first thing we need is what is called a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So you can see this qualifies here as a swing low. After the swing low, I need the opposite. I need a swing high. Here's your swing high. Swing high has a lower high to the left and a lower high to the right. So far, we have a swing low followed by a swing high. Now, we need another swing low. This is another swing low, higher low to the left, higher low to the right. That's lower than the first swing low. So swing low, swing high, lower swing low. As soon as this is in place, the key level for me is going to be the first swing high. Remember, this was the swing high. Swing low, swing high, lower swing low. Now in the future, if the price is able to go above that swing high, like it did here, that is what defines the order block. And the order block's the lowest closing bar prior to market structure change. As soon as you take out that first swing high, you change the market structure to the upside. Now, I don't buy the breakout of the market structure change. What I do is I wait for a pullback into the order block. Like for instance, we changed market structure here, and then you can see Southwest Airlines got as high as 44.86 up here. So if you're looking up here and then you look back to here, would it be fair to say that smart money was buying in this area when ultimately it went all the way up here? And the answer is yes. So when I say order blocks, what I'm really talking about is smart money area. So I'm waiting for the prices to come back into the order blocks. Now, there's different ways that I can enter from an order block. I can enter from a rejection of the high of the order block. I can enter with the rejection of the low of the order block, or I can enter with a under 30, over 30 RSI in the order block, or if there's some kind of moving average inside the order block, that is rejected. So this is the trade that I took here on the 30th of April. And why? Well, because the previous day we closed below the 200-day moving average. The next day we closed above the 200-day moving average. That is a rejection of the 200-day moving average. And cherry on top, the previous day closed in the order block, and then the next day it closed above the order block. So that, excuse me, is the confluence. Now, at the beginning of the podcast, I talked about structuring trades so that we have very good risk to reward ratios. Well, my stop on this, well, I have two stops. I have an emergency stop, which I'll talk about in a minute, but my end of bar stop would simply be a close back below that 200. Even if it closed a penny below, I would get out. Well, let me give you an example. This was a trade. I took the same trade here on the 23rd. Do you see how we rejected the 200-day moving average inside the order block? Next day, took off, great. Next day down, but it still closed above the 200. And then this day here on the 29th, it closed below the 200. So what did I do? I had to get out for a loss, a very small loss from here to here. That's fine. But if you get stopped out of a trade, you can always get back in if it re-signals the trade, which it did here. And you can see it's done well since then. And I do have a few trades that I got stopped out of this week, but I'll certainly be willing to get right back in them if they close above the levels that I'm looking at, just like I did here. So, okay, I took the trade here at 37.83. Why again? Close under, close over the major moving average, and also close in the order block, close above the order block. That's the signal. Now, the first thing I need to do when I enter a trade is I need to figure out how many shares I'm going to buy. So I have a formula that I've used for over 30 years, very comfortable with it, works well for me, that measures the volatility of the market. So the first thing I need to do is I need to know how much is in my trading account. So let's just say I have $100,000 in my trading account. I take 1% of that. That's going to be the maximum allowed loss that I have on this trade. If I have a $200,000 account, $200,000 account, $2,000 is going to be my max loss. If I have $1 million, $10,000, right? So let's just say 100,000, 1% is 1,000. That is as much as I am willing to lose on this trade. That's 1% of my account. It's not fun to lose, but you can make it back. It's not going to destroy your account. And so what I do, 1% of my total capital, $100,000 times 1% is $1,000. Now I look to the value of the 2ATR. 2ATR basically measures volatility, like how much is this moving? If I have a high number and divide it into this, I'm going to get fewer shares. So if volatility is higher, I'm going to get fewer shares. If volatility is lower, I'm going to be able to buy more shares. So all I do, 1% of my total capital, which is my maximum allowed loss, divided by the value of the 2ATR, divided by 3.58, it tells me to buy 279 shares. All right, so now I have position size correctly based upon how much I have in my trading account and factoring in what the market volatility is. Works out great. So 279 shares here now, here at 378.83. Now, the very first thing I do as soon as I enter, I go back to the value of the 2ATR, 358, and I subtract it from my entry price, and I place a red line down here. This is my emergency stop. Now remember, if I have 279 shares and it moves down 3.58, how much have I lost? $1,000, right? We've already done the math. So really my maximum allowed loss on this, barring some huge gap down, doesn't usually happen, but barring some huge gap down, I know if it gets all the way down here, I have lost $1,000. Now, the good news is that only happens about 5% of the time. It does happen, but hitting your emergency stop only happens about 5% of the time. The other 95% of the time, if I have a loss, it will be because of my end of bar stop. Or another way to look at it is it reverses why I entered the trade, essentially. So I entered the trade with a close under, close over the 200. Therefore, the next day, even if it closed 1 penny under that 200-day moving average, the black line, I would simply get out. So 95% of the time, my loss is going to be a smaller loss than this emergency stop. But I have to have this down here just in case, okay? So entry price minus the value of the 2ATR is my emergency stop. If I get there, I lose 1% of my account, but 95% of the time, if I have a loss, it's going to be because I closed below my end of bar stop, not my emergency stop. Okay, the next thing I do after I enter, I look for the value of the 1.5 ATR. The value of the 1.5 ATR right this moment is $2.69. So as soon as I enter a trade, I look at the 1.5 value. I take my entry price plus this, and I place an orange line above. This is my trailing stop mode. So in trading, when you enter a trade, when it reaches a certain level above your entry point, you don't want to give that back. And for me, 1.5 ATRs makes the most sense. So if I enter and the price does eventually get to my trailing stop level, it doesn't mean that I do anything. It just means now I am in trailing stop mode, which means in the future, if I have a close below a previous bar's low, I'm going to exit half of my shares. And by exiting half of your shares, that has the effect of moving all your stops up by half. I'm not actually moving these lines up, but I'm cutting my position in half, which has the same effect. So as you get into a trade and it starts moving your way, you want to start tightening up your stops. And this is how I tighten up my stop, by going into trailing stop mode, again, which I don't do anything. It just means now if I touch that trailing stop level line, now in the future, if I have a close below a previous bar's low, I'm going to exit half as a precautionary measure. Okay, so everything I've talked about so far, the emergency stop, the end of bar stop, the trailing stop level, these are all defensive moves. Or in other words, if the stock market or my position moves against me in a direction that I don't want to happen defensively, I have to take a defensive move and I have to sell something, right? Defensively. But I don't like just playing defense. I also like to play offense. And the way that I play offense is I sell a portion of my position each day, not all, just a small portion, if it moves a certain distance from the previous day's close. So let me give you an example. I'm currently in this position right now, and I'll show you exactly how I do this. So every day I look at the closing price. Closing price, 41.31. Now I look to the value of the 0.45 ATR. Right now the value is 81 cents. I just take the closing price plus 81 cents. My first profit target for Monday is 42.12. So I'll just put a line there, 42.12. There's my first profit target for Monday. Now, I place 3 profit targets to get, so the first profit target is the closing price plus the value of the 0.45 ATR. To get the second profit target, I take the first profit target, 42.12, add the 0.45 to it again, plus 0.81. My second profit target for Monday is 42.93. And that's how I get my second profit target. And then I do it one more time. I always place 3. How do I get my third? I take my second profit target, 42.93, plus 81 cents. My third profit target for Monday, 43.74. And there we go. So those are my 3 profit targets for Monday. So how much profit do I take at each level? I place 3. I place 3 in the system as limit orders. However many shares I go into the day with, I sell 10% at each target. So if I have 50 going into the shares with 50 days, if I go into the Monday with 50 shares, I would sell 5 and 5 and 5. And if I have a decent day up, I may hit 1, which is great. Reduces my position size, locks in the profit, taking advantage of being offensive instead of defensive, right? It reduces your position size, which takes the account heat off, meaning there's less stress because you have fewer shares. If there's less stress, you're more likely to follow your process. So to me, I'm a big fan. I'm a big proponent of taking partial profits. There's some days where it will gap way up. Maybe I'll hit 3 profit targets and then it reverses way back down. I'm sure glad I did them, but it just makes sense to me, just like in sports, play offense and defense. So my emergency stop, my end of bar stop, going into trailing stop mode, defensive, taking partial profits each day if they reach these certain levels also makes sense to me offensively. All right. So now we've kind of covered the basics. Let's just go back to the entry. Again, we have smart money area, in other words, an order block. The previous day we closed below the 200-day moving average. Next day we closed over the 200-day moving average. And this order block lives in, this moving average lives inside the order block. So that is my trade. That is why I entered at 37.83. I position size, I placed my emergency stop 2 ATRs below. My end of bar stops closed below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above, and the next day took right off for me. Great, hit multiple profit targets into that strength. Next day, no profit targets. Next day, up nicely, profit targets. Next day, up very nicely, multiple profit targets. And on this day here on the 6th, I also got to trailing stop level. Doesn't mean I do anything. It just means in the future, if I have a close below previous bar's low, I'm going to get out of half. The next day was up near the highs. I hit one profit target and then it reversed back down. And then today, down a little bit. But this did not close below previous bar's low, so I didn't have to exit half of my position. If Monday we closed below today's low, I would exit half. So anyway, that's a combination of a deep dip buy and an order block with a very good initial risk to reward ratio. And currently this particular trade is up 8.47%. So really good trade. All right, UNG. I have a couple interesting strategies that I don't use them all the time, but this week I actually have quite a few of these. So this is natural gas. Let me go all the way back here to why I entered the trade. If you can see, this is back in January of this year, and there's these 3 bars here that I've highlighted in green. So what's unique about these bars is that they are called an island reversal. An island reversal happens when you have a gap down. You can see this previous day here on the 13th, we gap down. Then we move sideways for more than one day, and then we gap up. And it kind of leaves these 3 bars all by themselves. This is bullish. This is called an island reversal. And you can see for the next week or so, it really was bullish and it moved up. The key is when you have an island reversal, the high of that island reversal, which is the high of this bar on the 14th, that if the market comes back to that price, there's a lot of inherent support at that price. So I didn't mess with UNG until the day that I took the entry. And I took the entry here on 415. Why? Because it rejected that price. Remember the price I just showed you, the top of the island reversal? It rejected it. So that is why I entered the trade. And I entered here at 1057. Now, I just got done telling you about playing offense and defense and phasing out and emergency stops because I use that on every single strategy that I use except for this one. If I have a rejection of an abandoned baby or I have a rejection of an island reversal, I make it very simple on myself. I position size, I have a 2 ATR stop below me, so if it goes down there, I'm going to lose 1%. But to the upside, I place a limit order for my profit target for 4 ATRs above. So I'm risking 2 to make 4. So if I'm right, I'm going to make twice as much as if I lose. And in my experience with island reversals, abandoned babies, it is more likely to go up than it is down. So it's more likely to go up. And if it goes up, I'm going to make twice as much as what I'm risking to lose. So there is the reason that I do that. That's called the asymmetrical trade. You should have that in every single trade. So this is a very, very easy trade. I set a 2 ATR stop. I set a 4 ATR profit target, and I'm just going to let this go. 100% let it go. Eventually, I think this is a true statement. Eventually, I'm either going to hit my stop or I'm going to hit my profit target. I don't have to manage it very much. The key important thing about this trade was I waited for the starting trade, the key level, and I waited months for it to get here. So after I entered, it took off right away. Then it came down, and then it rallied, and then it came down, and then it rallied, and then down. And ironically, I'm 100% to the penny break even on this trade at the moment. So we'll see. Like I said, I'm just going to let it run. I'm either going to lose 1% or I'm going to make 4%. So break even on this trade. Silver. All right, so silver's kind of a hybrid of an abandoned baby and a rejection of the order block. So you can see the bar that I have circled in blue is an abandoned baby. Abandoned baby is the same thing as an island reversal. It's just that it consists of one bar instead of multiple bars. You can see the previous day on the 13th, we gapped down from the 13th to 17th. So that was a Friday. So from Friday to Monday's open, we gapped down. Very bearish sentiment. However, the very next day, Tuesday, it gapped up. And when you have a very sudden shift from very bearish to very bullish very quickly, there's an edge that more times than not, you will be higher than lower. So we have the abandoned baby. That's one reason I took the trade. The other reason I took the trade was that the previous day we were in the order block. We were in the smart money area, but then the next day we closed above it, rejecting the high of the order block. So that's the confluence of signals: the close in the order block, the close above the order block, and the bullish abandoned baby. And again, with abandoned babies and with island reversals, I do the same thing as I just told you on the previous trade. 2 ATR stop, 4 ATR profit target. I'm just going to let it go. Eventually, one of those will happen. So as soon as I bought it, the next week, it just went straight up. And I was like, boy, I really nailed this trade. But I'm waiting for the 4 ATR profit target. Then we kind of moved down, and then we really moved down, but we didn't get to my 2 ATR stop, so I stayed in the trade. And so I've kind of ridden this thing up and down and up and down, but that's just, when you set I'm either getting out for a 1% loss or a 2% gain, this is to be expected. And then we rallied up here and we came back down, although the last 4 or 5 days have been fairly decent. So just waiting to hit my 2 ATR stop or my 4 ATR profit target. But this trade, at least at the moment, is doing fairly well, up 4.31%. Nike. All right. So Nike is an order block trade. And again, why the order block? Swing low, swing high, lower swing low. Market structure change to the upside. As soon as market structure change happens, I want to look for the lowest closing bar prior to the market structure change. That's my smart money area. I bring the smart money area into the future. I don't buy the breakout. I am waiting patiently for it to come back to the smart money area. Now, I really like when there's major moving averages inside the order blocks. Really my favorite. However, sometimes you have order blocks where there are no moving averages in here. So I make my own if there's something valid to make these from. Well, let's go back to this bar here on the 13th. This is an abandoned baby. Why? Previous day, we gapped down. Next day, we gapped up. Not a lot, but we gapped up. So that's a bullish signal. And for a week, it really was. But remember what I told you. The high of the abandoned baby is going to be some inherent support. So I drew a line at the high of the abandoned baby, brought it forward, and I was looking for a rejection of that high, which happened on the day that I entered. And so I entered here at 43.06. My emergency stop is 2 ATRs below. As always, I place my 1.5 ATR trailing stop level above, and my end of bar stop is simply basically a close below 43.06. So if the next day it had closed like 43.01, it would have closed below the high of this abandoned baby key point, and I simply would have got out, hopefully for a small loss. Remember, I have my 2 ATR stop down there in the worst case scenario, but rarely does that hit. But this is a very good example of having a line in the sand, and as long as it stays above the line in the sand, I'm in. The next day, if it had closed down just a little underneath that, the value of that high, I just would have been out. I could have always got back in the next day. All right. So I entered here 43.06. Next day, took off. Perfect. Started off really good. Hit some profit targets. Next day, up again. Hit some profit targets. You can see I have my 1.5 ATR trailing stop level up here. It didn't quite get there, so I'm not in trailing stop mode yet. Monday, if it were to go higher and get there, now I'm in trailing stop mode, which means in the future, if I have a close below previous bar's low, I'm going to sell half, but we're not there yet. All right. So anyway, this trade's doing okay. I mean, it's been a 3-day trade, not too bad, up 2.47%. It's really interesting how on the day that I bought this trade, though, the market did test below there, but yet closed back above, and as soon as it did, it moved up. So pretty good, up 2.47%. VIX. All right. VIX has been okay. It's down a little bit, but this is an order block, the green box. This is an order block from the past, a long time ago, as a matter of fact. And all I was doing is waiting for, well, let's go back and give you a good example. Here's the order block back here on 225.26. Why? Swing low, swing high, lower swing low, market structure change. Now this, as soon as we change market structure, the order block is here. The high is 28.06, the low is 27.37. Well, we went from basically $28 up to $39. So when you're up here at $39 and you look back here to $28, is it fair to say smart money was buying here when ultimately it went to $39? Well, yeah, of course, 100%. Okay, so I have the order block level, the smart money area. I bring it into the future. And if you've been watching this podcast for any length of time, I said, if and when VIX gets back to this smart money area, I will look to buy. And so that's exactly what happened. I had to wait a long time for it to get there, but I ultimately did buy here on May 1st at 28.20. Why? Because on this particular day, we rejected the high of the order block. Now, this is a very thin order block, very short order block, skinny order block. So if I had a very tall order block, I would not have taken this trade. Because if I get in with the rejection of the high of the order block, my stops close below the order block. But this order block is so skinny that it still offers me a good risk to reward ratio. So I got in here 28.20 because of rejection of the high of the order block. We went in the order block and then we closed above it. In addition to that, we also created what's called a V1. A V1 is a very good entry signal, V1s, V2s. I use them in my trading all the time. If you'd like to learn more about them, just go to my YouTube channel. I have a video there. Just type in V1s, V2s, Greg Gossett, and you'll see. But they really do improve the accuracy of entries when you have a V1, and they're very easy to learn. They're great. So I had a V1 and I had a rejection of the high of the order block. I got in 28.20. I position size based upon the current marketility of the market. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. Well, it got down pretty low today, but it reversed back up. So next week, if it closes below this green box, that'll be the end of the trade. But again, it's a very good risk to reward ratio. And we saw what VIX did all the way up here. I'm not saying it's going to go all the way back up there, but I'm just saying maybe it could get to here. Maybe it could get to here. That would be a pretty good return on the initial risk that I have. So this particular trade's pretty close to being even. It's down slightly. It's down 0.53%. But again, I like the order block. I was very patient and waited for it. Doesn't mean it has to work, but it means that if it doesn't work, it probably won't be too big of a loss, which is how I want to structure all my trades. So VIX down 0.53%. Okay, so those are the open positions. Let's talk about the closed positions that I got out of. Now, this week, as I mentioned at the top of the podcast, this week was all about tech, all about AI, momentum trades where the momentum just goes up. I don't trade momentum. Usually it doesn't work. This week it has worked great. So if you guys are trading momentum at the moment and you had some good trades, great. Really, really happy for you. Congratulations. It was an outstanding week. But I buy dips, right? And in this particular week, the the stuff that's going up just kept going up. The stuff that was going down just kept going down. So for the way that I trade this week it was difficult, and that's why I got stopped out of so many trades. So I did enter XLV, which is the healthcare ETF here, at 144.20 144.72. Why? Well, there was a previous order block in the past. And you can see we have the 250-day moving average, the purple line. We have the 300-day moving average, the orange line inside of this order block. We had a huge move up, and then I waited for a pullback and a rejection of that 250, and I entered at 144.72. Placed my emergency stop 2 ATRs below. My end of bar stop, why did I get in the trade? Because it rejected the 250. Therefore, if it closed below the 250, which is very close to my entry, I'll just get out of the stock. And that's what happened. So the next day it went up, I hit a profit target. Next day it went up, hit a profit target. So at least I got that, mitigated the loss. Yesterday it came back down, or Thursday it came back down, rejected the 250 but closed above it. That kept me in the trade. But today we closed below the 250 and my trade failed. So I had to get out, and I got out for a loss of 0.87%. So percentage wise wasn't very bad, but those are my rules. It rejected the 250. That's why I got into the in. If it's weak enough to close below the 250, I have to get out. And that's exactly what I did for a loss of 0.87%. PCG. All right. Really like this trade. Was working out pretty well. It's my favorite trade. It's an order block, green box, with a major moving average running inside it. I entered here on the 6th of May at 16.16. Why? It rejected the 200-day inside the order block. So after I entered at 16.16, I position size based upon the volatility of the market. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below the 200. Yesterday it dipped below the 200, but closed above, kept me in the trade. Today it did close below the 200. So I had to get out of the trade. Wasn't a big loss, not a big deal, down 0.56%. In the future, if we close back over that 200, I can get in again, just like I showed you on Southwest Airlines. But this one did take a loss of 0.56%. But again, these are losses, but these are small losses, right? That's proper trading. You're always going to have losses. I guarantee you. Maybe this week nobody feels like they're going to have loss again, but they will. I promise you. Same thing with Lockheed Martin. I got into Lockheed Martin here on the 27th. I've been in this trade for quite a long time. Previous bar rejected the 250. I didn't get in that day, but I got in the next day. I position size. I placed my emergency stop 2 ATRs below, my trailing stop 1.5 ATRs above. My stop is simply a close below the 250. 1, 2, 3, 4, 5, 6, 7, 8 days. It held above the 250. It tested it a couple times intraday, but it held. Today it closed under, not by much. I mean, the 250 was 508.94. It closed at 506.51. All right. So, yep, it did close below. I had to get out and take a small loss of 1.34%. But again, going forward, if we close back over that 250 again, it would be another valid trade, just like I showed you on Southwest Airlines. I got out, I got in, It worked for a minute, got out. Next day, closed back over. I got back in, and then it finally went. So this trade here, a loss of 1.34%. DIA. All right. Well, DIA is a short trade that I took. Now, you've heard me talk about the green boxes, the bullish order blocks. Well, there is such thing as a red box, a bearish order block. And this is why I shorted this trade. Back over here, a bearish order block is just the opposite of a bullish order block. So for a bearish order block, we need a swing high, followed by a swing low, followed by a higher swing low, and a market structure change to the downside. So look down here. See the green order block? This is the bearish one. This is the green. Look at that. Rejected the bottom of the order block, and it called the bottom. So I got in here, shorted the Dow here at 494.27. Why? Because during this day, we went above the 70 RSI and closed below it. So we rejected the 70 RSI, a key level inside a bearish order block. My end of bar stop was a close above the 70 RSI or a close above the high of the order block, whatever one came first. So the short was working out for a little while. I took some profits here. I took some profits here. I took some profits here, thankfully, right? Because I locked those in for partial gains and I reduced my position size, which really helped when it ultimately stopped me out. Then we had a big move up, but it didn't close above the order block. And then we gapped above the order block, closed back below. Then we came down, which again, took some profits here. But here on the 6th, we closed above the order block. I had to follow my rules, take my medicine for a loss of 0.92%. So you can see I've had multiple losses here, a lot more than I usually have on any given week, but they're small losses, right? And it's not that I can control the market, but I can control when I get in if I have a good risk to reward ratio. And then the next couple of days it came back down, right? But that's how it goes. So I did lose 0.92% on this DIA short. And then Netflix, again, another loss, but this is a very good example of, again, taking small losses. I entered Netflix here on the 28th of April at 92.18. Why? Rejection of the red line, which is the 100-day moving average, rejection of the 100-day moving average, rejection of the bottom of the order block, and a V1. This is a really good setup. It didn't work. You can have great setups that don't work, but I would take this, if I had this trade another 100 times, I'd take it another 100 times. And very likely 70 times out of that 100 times, I would make money. This is just one of the times that it didn't work. So I got in here at 92.12, rejection of the bottom of the order block, rejection of the major moving average plus a V1. I placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. Next day didn't do much. Next day went up. It's grateful that I hit some profit targets on that move up, the intraday profit targets. Again, I locked in some at a profitable level and reduced my position size for when it ultimately failed. The next day reversed back down, but held above the 200. And then the next day here on the 4th, it closed below, I'm sorry, not the 200, the 100, the red line. That was my stop, right? It wasn't a big loss. It was a 1.23% loss, but the key thing is it lost the level. It lost the support I was looking for, and look what happened to Netflix after that, right? So it's not fun to take a loss, but if you do take a loss and it continues down, boy, you are sure glad. But ultimately, again, it was a very small loss. I had a really good setup. I waited a long time for that setup. It came, it just didn't work. But again, if I had this trade another 100 times, I would take it another 100 times because I know in the long run, this initial setup is profitable, just not on this particular trade. So a loss of 1.23%. So, all right, there you go, everybody. That's the open trades that I have. These are the trades that I closed. And like I said, more trades than I usually, or more losses than I usually have, but it was a very unique week. It really, really was. The high stuff kept going higher, the low stuff kept going lower. But more times than not, that does not happen. I mean, this is a bit of an anomaly, right? So keep that in mind. So, all right, listen, before we look at the potential trades for next week, I always like to talk a little bit about trader psychology. This is from Trader Lion. You can follow Trader Lion at Trader Lion underscore. This is a very short post, but it really says a lot. You decide your habits, and your habits decide your future. Okay, we can apply that to a lot of different things. If your habit's to get up early, go to the gym, over time, you're probably going to be pretty fit. If your habit is to, I don't know, I guess I don't want to say anything bad. So if you have bad habits and you do them all the time and they become your habits, do you think that's going to decide your future? Yeah, probably. Probably. And in trading, everyone, since that's what we're talking about, you decide your habits and your habits decide your future. If your habit is to gamble on stocks, you're going to gamble on stocks. Buying calls, way out of the money calls. If you keep doing it, it will become a habit. And trust me, that is not going to work out well for you. And that is going to decide your future in a negative way. But if you take trading seriously with a proper trading plan, with the right numbers, and you follow your plan, if that becomes a habit of trading correctly, in the long run, you're going to make money. And that will decide your future. It will improve. But if you don't respect your stop losses, if you trade too large, if you're gambling, if you're chasing news, and that becomes your habit, it's not going to end up well for you. I promise you, in the trading world, your future will not be bright. But if you do things right, have your checklist, do the math correctly, adhere to your stops, be patient, waiting for the entry. In the short run, maybe it's not going to improve your future. But in the long run, if you do that and good trading habits become your habits, it is going to dictate your future. So listen, whatever it is you're doing in your life, you decide your habits and your habits decide your future. So get yourself some good habits in life and in trading. So really short sentence, but really means a lot. This is a great post. Thank you very much, TraderLine. Appreciate it. All right. So listen, I told you at the beginning of the podcast that I have in 7 different potential trades that I'm looking at for next week, and I do, and I'm going to show them to you. But I do want to tell you that, okay, so here I have 7 for next week. Is it possible that all 7 of these could trigger on Monday, for example? And the answer is yes, theoretically they could. Does that mean I would take all 7 trades? 100% not. If all 7 of these triggered on Monday, I would have to narrow it down to the best trade. And trust me, I would be able to find the one that was the best out of the 7. And so how do I do that? I give every particular setup like a score, a report card. For example, if it has a rejection of the 200 and that's it, I give it 1 point. But if I have a second one that has a rejection of the 200 and a rejection of the order block, well, that gets 2 points. And maybe I have a third. Maybe it rejects the 200, maybe it rejects the order block, and maybe it has an under 30 over 30. That would get 3. Which one do you think I'm going to take, right? So I also look at the risk to reward ratio. Maybe I have a lot of entry signals, but the risk to reward ratio is not so good. Well, I have to back it out. I have to readjust. I like to look at the higher time frames. This gives me an idea on a higher time frame of what's going on, and maybe everything being equal on the daily, something on the weekly would go, oh, this one's the best, right? I also look at relative strength, which just means if the market's down, but a particular stock is up on a down day, it gets bonus points. If the market's up and the stock's down, it gets negative points. So this is how I trade. This is what I teach my students. And if I could just take a moment, put in a quick plug for myself, but I do teach students all over the world. I teach a 20-hour course which I think is an excellent course. I teach you everything that I have learned in my over 30 years of my trading career, all the setups, all the rules. And I think the best way to learn anything is one-on-one with your instructor, just one-on-one, so you can ask as many questions as possible. And so that's why I structure the course that I teach one-on-one, 20 hours. We do 2 hours a week for 10 weeks. And I'll teach you every single thing I know about trading. I've really turned out some great traders around the world, working with some really good ones at the moment. And I really like to see them starting to understand and put it to use. Doesn't work all the time, every week, right? It doesn't. But over the long run, it will work for you, because that's how I've made my living for over 30 years. So if you're interested and you would like me to be your teacher and teach you for 20 hours, we'll spend a lot of time together, 2 hours a week for 10 weeks. We'll see a lot of different changes in the markets. We'll see a lot of different scenarios happening. So you learn a lot. You really learn a lot. So if you're interested, my email is in the link of this description. All you have to do is send me an email. So, Greg, I'm potentially interested in your course. I'll say, great. Let's kind of do a get to know you call. It's not a sales call. I promise you, it's not a sales call. I just want to put a face to the name, learn more about you, your trading challenges, your trading goals. And it's also a really good time for you to ask me any particular questions about the course and how it's structured and so forth. So anyway, I'd love to hear from you. Just send me an email. Now, I also, if you like online courses, I have a really good online course at udemy.com. The link is in the description of this video as well. I teach you step by step how to trade the deep dip buy strategy. That course is 9.5 hours. It's a really good course. It took me like 6 months to put that course together, but it's really good. And I sold a lot of those. And it's very affordable, somewhere between $30 and $50. And the links, the Udemy links in the description. So the one-on-one course, of course, that's the best, because you got me for 20 hours, right? And to send me an email, or the online course, you can hit the link. So anyway, thank you for letting me put my time in for my plug, and let's get back to business here and see what I'm looking at next week. All right, this is DoorDash. So you see the green box here. What's that? That is an order block. Why is that an order block? Well, look, here we have a swing low, and then we have a swing high, and then we have another swing low that's lower than the first swing low. And then in the future, did the market go above that swing high? It certainly did. It certainly did. So market structure changed here. As soon as the market structure changes, I look for the lowest closing bar prior to market structure change, and I bring it into the future. Now, again, when DoorDash rocketed way up here to $191, and I know the order block's down here at like 151, is it safe to say that smart money was buying here when ultimately it went here? Yeah, 100%. So does that mean that if I wait for prices to get back down here, it's going to be smart money again? Not necessarily. Things can change. All order blocks don't work, but I can tell you from experience that more times than not, it is smart money again. So the key at this point is just to be patient and wait for DoorDash to potentially get down in this smart money area. It may not. It may just take off from here. That's all. Now, if we look at this order block, do you see any moving averages inside here? There is not. But like I said, I make my, when there's not, I will look to the left and see if I can make some kind of level by myself, just like I did with Nike. So the level that I put in here on DoorDash is 151.40. Why? Well, if we come back here to these three bars, this is called a V2. A V2 consists of three bars: bar 1, bar 2, bar 3. And the rule is bar 2 has to go underneath bar 1's low. Bar 3 has to close above bar 1's close. It's a V2. Worked out pretty well. But what I'm looking for at this 151.40 level is the halfway of the number 2 bar. We call the number 2 bar the washout bar. When you have a V2, the inherent support will be at halfway of the high and the low of the number 2 bar. So I know there's going to be some inherent support here. Doesn't have to be, but more times than not there is. So what am I waiting for? What I'm waiting for on DoorDash is I'm waiting for DoorDash, if it does come down and reject that 151 level, that will be my buy area. And if it does reject 151.40 and close above and I take the trade, then my stop will simply be a close back below 151.40. So that's what I'm looking at. I'm looking at the halfway of the V2 as the support level that lives inside the order block. So I'm looking for a rejection of DoorDash next week of 151.40. FedEx. All right. Well, I talked a little bit about bearish order blocks, and I guess I should make this more bearish looking. There we go. This is a very strong break to the downside. This is a bearish order block. Bearish order blocks, we have swing highs, followed by swing lows, followed by higher swing highs, and break of structure. This certainly broke structure. Now, I am waiting, since we broke structure to the downside, I'm waiting to short a rebound or a counter rally. So I know exactly where I want to short this. I want to short this at 398.10. Why this level? Because it's halfway at this big down bar here on the 1st of May. If you have a big down bar and you rally back to halfway, that is potential that is a inherent resistance level. So I'm looking for a rejection of 398.10 inside the already bearish order block area. In addition to that, if we were to reject the 70 RSI inside the bearish order block, I would also consider taking that. So a rejection of the 70 RSI inside the bearish order block, or a rejection of 398.10 inside the bearish order block, and then my stop would simply be a close back above 398.10. So key levels within key levels, whether we're talking about bullish order blocks or bearish order blocks, key levels within key levels. Key level on a bullish side would be 200, 250, 300, 30 RSIs. Inside a bullish order block, that's bullish, key level within key level. And this is the opposite. Bearish levels within bearish levels. Bearish order block, bearish levels, like a rejection of the 70 RSI or a rejection of 398.10. Lockheed Martin. All right, well, I just got out of Lockheed Martin, so why am I thinking about getting right back in? Well, because I got in with the rejection of the 250. Today, we finally closed back below. So is that it? My last chance on LMT? Absolutely not. I have two levels right now that I'm looking at. Next week, if we close above the 250, and right now it's 250's 508.94, I would certainly consider getting back in it and then using the 250 as my end of bar stop. However, if we go lower, there's another key level down here, 300-day moving average. And the 300-day moving average is 498.98. If we go lower and reject that level, then that's my new level. As long as it stays above 300, I'm in, but if it closes back below the 300, I'm out. So at this point, it either has to go up for me to get interested, a close back above the 250 of 508.94, that would be totally legitimate, or if it goes lower and rejects the 300-day moving average at 498.98, that would be another entry signal, and my close there would be a close back below the 300. McDonald's. All right, so I've been showing you everything on daily charts, but I want to switch to weekly charts on McDonald's. So every bar here is a week, not a day. Well, look at this. We are at a key level. We have the 200-week moving average inside a bullish weekly order block. The 200-week moving average is 275.84. Currently, we're at 275.75, 9 cents below. So next week on Friday, because weekly bars close on Fridays, next week, if we close above this 200-week moving average, a nice gentle close. I don't mean it races up here, then I would not take the trade. But if we have a nice gentle close above that 200-day moving average, 200-week moving average, I would certainly consider taking the trade, especially if the risk to reward is good, because then if I'm wrong and it closes back below the weekly 200, I would simply get out. But again, it's structuring the trade to begin with a good risk to reward ratio. That if you're right, you have the chance to be right a lot, big. But if you're wrong, you have the way you structured it is that you structured it that you can have a very small loss if you're wrong. But this is a big time level. And you can see McDonald's has come down significantly, but we are at a key level. So next week, if we close above 275.84, a nice gentle close, not a huge, massive rally, I would certainly consider that, taking that trade on the weekly time frame. But I have to wait for Friday for that to happen. RBLX back on the daily. Okay, so RBLX really got hit. We have an order block, not a very tall order block, pretty skinny order block from years ago. I had to go back years to find this order block. And then we had whatever bad news they had. Look at this. Where did it stop? Right at the top of the order block, and then it rallied and continued up. I didn't like it up here. I felt like it was stretched, and actually told a student of mine, yeah, I'm kind of interested in RBLX, but if it comes back and pulls back and retests the order block. Well, that's exactly what it did. But currently we closed below the high of the order block. Looks like the high of the order block is 42.13, looks like, and we closed at 41.90. So next week, if we close above 42.13, I would certainly consider getting into the trade on Monday. Or, on the other hand, if we close and have a rejection at the low of the order block at 39.67, I would also consider taking that. So that would be if it went below the order block and closed back in the order block, I would certainly consider taking that. My stop would just be another close back below the order block. So these numbers are kind of rough here, but the high of the order block is 42.13. The low of the order block looks like it's about 39.67, something like that. So if we reject the high of the order block by closing back above, I would consider it. If we reject the bottom of the order block by going below and close it back in, I would consider getting long there. But this is a key level from years ago. Doesn't mean it has to hold, but it gives me a good structure for the trade. XLE. All right, so energies really got hit on the head, but there is a very nice potential setup. I don't know if it's going to work. I don't know if any of these are going to work. I never know if any are going to work, but I have my levels that I key off of, and that's it. So we have an order block here. Why order block? Swing low, followed by a swing high, followed by a lower swing low, followed by market structure change. The market structure change define the order block. It's here. It's the lowest closing bar, the high and the low prior to market structure change. So that's our order block. Bring the order block into the future. Well, what lives inside the order block? 100-day moving average, the red line. Currently, it's at 53.57. If XLE continues down and rejects that 100-day moving average, meaning it goes below it, closes back above it, yeah, I would certainly consider taking that trade. And my stop would be a close below the 100-day moving average. So pretty simple. So next week, I'm just looking for a rejection of the 100-day moving average. And today, that is at 53.57. You know what I forgot? I forgot to show you the trade I entered the day. I don't know why I didn't mark that up. Well, I'll tell you what, let's finish with the last potential entry, and then I'll show you. I don't know why I didn't put it in here, but as soon as I saw this, it reminded me that I took a trade just like that today, and I didn't put. So the last one for next week is XLV. Now, this is interesting because I got out of XLV today. Why? Because I took XLV with the rejection of the 250 and it closed back below the 250. So I got out. But it triggered another entry today. Why? Because we have an abandoned baby. The high of the abandoned baby is a support level. So if you reject the top of the baby, that is a entry signal. Well, look what it did today. That's exactly what it did. So you might ask, Greg, why did you not just stay in the trade? Because I don't like to do that. I don't like to get into one trade, get stopped out, but then have another signal on the same day, and then I could just continue down, down, down. It's just, I guess it's fine because it was a legitimate entry. If I was not in XLV, I would have taken it today for sure. 100% for sure. Nice rejection of the high of the baby inside the order block, but I was already in a trade. So I just want to keep my habits correct, right? So that being said, next week, if we were to retest this level, the 143.28 level, and close back above, then I would be okay to go in and enter. Because remember, I only enter one trade per day, and I did enter a trade today already. All right. So, but this does still look good. It just came all the way back down, rejected that key level, closed back above. So going forward, I guess what I'm saying, if I get another retest of 143.28, I could take it because then it starts as a new trade. Or even if it stayed right where it is on Monday and I didn't have another trade, then I would just treat it as a new trade. All right. So that's the key level 143.28. And like I said, I don't know why, but I did enter Exxon today. Why Exxon? See, this looks very much like XLE. That's why it reminded me. We have a nice order block, and we have a 100-day moving average inside the order block, and it rejected. You can see during the day we went below it, and then we closed back above it. Perfect. Do I know it's going to go up? Absolutely not. I have no clue whatsoever. But the only control I have is having a good, waiting for a proper entry, having a good risk to reward ratio, position sizing correctly, placing my emergency stop 2 ATRs below. But the key point of this trade, everyone, is just the close is just a close below the 100. Look how close I am to it anyway. The 100 is at 144.04. We're at 144.57. That's 53 cents away. That's not a very big risk with the potential for a nice reward, good risk reward. So I'm break even on the trade because I just got in today, rejection 100. Next week, if we close below the 100, I'm out. If it starts to move up, I'll take partial profits. If we get to trailing stop level, I go into trailing stop mode. It's very simple. And of course, I have my 2 ATR emergency stop down here if I'm really, really wrong. So anyway, that's what I have for you today, everyone. I hope it was helpful. If it was, I really would appreciate it if you just take a second, hit the thumbs up button. It really helps the channel a lot more than you know. If you haven't, if you're not a subscriber, I invite you to subscribe. That would be fantastic. Thank you very much. And I always like to leave off everyone with, try to go out and do something nice for someone every day if they have the opportunity. It's going to make their day. It's good for you. You like it when somebody does something nice for you or a nice act of kindness. And I think this world really needs it. You know what I mean? It's free. It's just helping somebody if they drop something. It just makes a lot of sense to me. And so I have my small little platform, but I at least like to say that every week. And I also like to say I'm a big animal lover, and animals appreciate acts of kindness just like you do and just like we do. And so, I mean, if you have the opportunity and you can do a nice act of kindness for an animal, do it. It's good karma. The animal appreciate it, and it's good for you too, trust me. So look, if you have any questions about anything I talked about today, please put them in the comment section. I'll do my best to get back to you as soon as I can. And God willing, I will see you next week. So really enjoy your weekend. I have a baseball game tomorrow. I have not had a good start to my baseball season this year, so I'm hoping tomorrow I can get a couple hits. So I'll let you know. I'm almost 60 and I'm out there playing with dudes that are 20 and 30. So I'm like the old man on the field, but I'm trying to compete. I'm doing my best. All right, everybody. Thanks a lot. Appreciate it. Have a good rest of your weekend. If I can help with anything, just write me. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.